Hello everyone, this is Coach Wade, and I'd like to welcome you guys back to my channel. So hope you guys will like, share, and subscribe. Well, my goal is to help families move from crisis to recovery to prosperity when it comes to dealing with their financial life. Today's topic, I'm going to talk about some of the the importance of insurance, life insurance, to be specific. All right, we'll talk about the X curve, or some people call it the theory of decreasing responsibility. But before I do that, I always ask the question, what do you think life insurance does? I ask people that question all the time, and a lot of times I get an answer, which is not a wrong answer. They say it's to provide some money for loved ones, to help take care of final expenses and things of that nature. Okay. Well, all in all, that is a true statement, but life insurance does so much. Okay. There's so many different uses for life insurance. One particular use is for the living benefit. People may wonder, what exactly is living benefit? Well, living benefit is if you have a heart attack or a stroke or diagnosed with diabetes, not diagnosed with diabetes just simply, but if you lose your vision due to diabetes, losing a limb, things of that nature, where you can actually get a percentage of the face amount of that policy up front. In some cases, you're able to get up to 100% of the face amount of that policy up front. So what that means is if you have a $500,000 like life insurance policy and you're diagnosed with cancer, and depending on, what particular plan you have, because every carrier has different specifics, but you can get up to the entire $500,000 and it doesn't necessarily have to be terminal. So you can get access to the money while you're still living and help take care of medical expenses and things like that. Because a lot of people say, I have health insurance, but health insurance has limits, right? It has limits. Okay, health insurance has limits. And in some cases, things might not be covered. You never know. There's been cases where people get cancer, and there's certain things that the insurance will say, "Hey, I'm not going to cover that." So how would you pay for that? So it's good to have access to money. Not to say you want to use all your life insurance for that, but it's good to have a pool of money that you have access to in order to take care of some of these expenses. Another thing you can use it for is you can use it, to accumulate cash. Then there's ways you can accumulate cash and be able to have access to the money without having to pay taxes on it, allow it to grow, without having to pay taxes on it. All right, and when you actually use some of the money, like borrow from yourself, you still get paid interest as if you still got the money in there. So case in point, you have $100,000 in cash value, you take out $10,000, you still get paid interest on the $100,000, even though you pulled out 10. You want to pay yourself back, of course. Every carrier has different things. You see simple interest rates at about 5%. Some may be different depending on whatever carrier you go to. But hey, there's just another use for it. All right, another use for it. It could be used for retirement. You can actually annuitize. In some cases, it's usually a rider, but if you set it up right, you can annuitize your cash value inside your life policy to where it pays you a guaranteed income for the rest of your life. You can have it tied to an index where when the market does well, you do well. But the market falls and drops, you don't lose any money. All right. So there's a whole bunch of different little techniques and strategies that you can utilize with insurance. So I just want to stress the importance or the different uses of insurance, and that's only a few, but the different uses of insurance, all right, that you can actually use for yourself. Acquire the insurance for yourself to help benefit not only your family, but benefit yourself as well while you're living. All right. Some people have long-term care riders, because long-term care can be expensive. So having a pool of money there, long-term care, having a long-term care rider on your policy could be great. A disability insurance rider or whatever it may be. There's a ton. I haven't even scratched the surface on all the different things that you can do with life insurance. The list goes on. All right. So it is an important part of your financial strategy, having life insurance. You want to make sure you're building that on a proper foundation. So when somebody passes away, you won't be dealing with a crisis situation. You be dealing with either recovery or prosperity. Not that you want to prosper off somebody's death, but hey, that's a good way to leave a legacy behind. You know, um, you want to be able to leave a will, leave life insurance, and rather than just leaving bills, right? So that's critical, and that's going to be an important aspect of life insurance. All right, so there's a whole bunch of different strategies you can work out with that. But when it comes to what we call the theory of decreasing responsibility, or the X curve. It looks something similar to this right here, where if I can get this right, on this side, see, going backwards here, and you see the dark blue. You see this dark blue line. This represents wealth. You notice, it starts off low and it gets higher. Okay, as you go up, it gets higher, going the opposite way. And then you have the other line right here. This represents responsibilities. All right, the purple line represents responsibilities, and as you go down, you notice the responsibilities decrease. So what this represents is a timeline. And what this basically says that the younger you are when you're young, be in this area, you have a lot of responsibilities, but you have very little wealth. You're just not starting off. You don't have a lot of money. So if you die prematurely during this stage of your life, you want to have a lot more life insurance, okay? Because you don't have a lot of wealth. So you want to make sure life insurance is there to be able to take care of your family because you have more responsibilities. Responsibilities such as you may have a mortgage, you have children still in the home, you have debt, a lot of debt, you may have a mortgage payment, things of that nature. But the whole concept is pretty much the older you get, all right, the older you get, the more wealth you accumulate, and the lower your responsibilities, the lower your responsibilities. So as you get older, hopefully you've been saving. So you accumulated wealth over that period of time, over that 20, 30 years, you accumulated wealth. Hopefully, your responsibilities are less because now you've paid off all your debts, right? You don't have any debt. Mortgage is paid off. Children are out of the home. You've already taken care of their college, so right now you have a lot more, you have a lot more wealth, right? A lot more wealth. Dark blue line represents wealth, but your responsibilities have decreased in relation to when you were younger, when your responsibilities were much higher and your wealth was much lower. So this is what they call like the theory of decreased responsibility. In some cases, they call it the X curve. All right. So good concept to keep in mind. Let me try to put it a little closer so you can see some of this stuff. If I can get that right, where you see it says younger, generally less secure. You're older, generally more secure because you have money, you have wealth. All right, so decreasing responsibility and building wealth. So that right there is an example of the X curve or theory of decreasing responsibility. So if you're young, more than likely you're going to need a whole lot more insurance, right? And if you're older, you might not need as much because you don't have the same responsibilities as you had when you were much younger. All right, so that's the whole concept. By the way, having a good insurance policy is going to be important to your financial game plan because you can't build a proper foundation without life insurance. A lot of times, people instead of getting life insurance and they build a financial house wrong, start off with just investing. But what happens if you were to pass away, prematurely? What happens to your loved ones? Have you saved up enough, in investments? Will they be able to live off that for the next 10 years or 5 years or whatever your plan is for your significant others? We be able to take care of all the debt so your family can remain in the household. They don't have to sell the house or downsize or anything like that. Because it happens a lot of times, people are dependent on both incomes. Husband and wife both work, or maybe the wife doesn't even work, or the husband doesn't work. Maybe it's a one income household. So what happens to the household when the major breadwinner passes away prematurely and they're not prepared? What happens is things start to get lost. You lose the house, you lose the cars. There's financial stress, things that do not have to take place because if you properly prepared yourself in the first place, you wouldn't have to worry about or deal with that particular situation. So you have to always think about. I say this a lot of times. Life insurance is not necessary for you as an individual, unless you got living benefits, right? But it's for those that you actually leave behind. Life insurance is for those people that you leave behind, making sure that they're taken care of, making sure that your kids have a great start in life. If they're young in the household and you pass away prematurely, and you don't have nothing for them, just start from scratch. Leave that legacy behind for your loved ones and make sure you guys get life insurance and get the proper coverage. We do some videos like a little later on, doing some calculations and how to figure out how much life insurance to get. But everybody's situation is gonna be different. There's tons of different ways that you can kind of, plan for life insurance or plan for how much you're gonna get. But we can at least have a starting point so you can know, in general, how much life insurance to get for you and your household to see what works for you and your pockets, right? So you don't become, as I say, insurance poor, but if you want to get something that you can afford, make sure it's affordable, make sure it can fit in your game plan, make sure you have the right one. There's several different types of insurances out there, but mainly there's two types. But I like to talk about both types because it's not a one size fit all. Everybody's situation is going to be different. Some may need the one type, another may need another. So it all boils down to that individual situation. Okay, so you always got to look at it from a case by case basis. But don't forget, there's more to life insurance than just a death benefit. So a lot you can do with it. You don't have to be terminal to get access to it if you have the right policy. Okay, so some have good, living benefits on there. Not all policies have living benefits. So and not all living benefits are treated, equal. Some have better perks than others. But basically, don't want you to lose. Cut this phone on mute. Don't want you guys to, lose sight of, the things that life insurance can do for you. All right. So I'm going to go ahead and end it with there. Keep the video relatively short. So hopefully you guys like the video again. Hope you share it. Hope you subscribe to the channel. I'll be trying to put more information out there. Again, I'm just trying to help families move from crisis to recovery to prosperity when it's dealing with their financial life. But until we meet again, you guys have yourselves an amazing day.